everyone, this is Adam Gould, Head of Quantitative Research at FS Insight. So today I'm excited to discuss our new offering on the FS Insight website, our custom quant ratings. I'll start off by talking about quant rating models in general and how our quant rating system differs from others. Next, I'll briefly touch on the performance of our quant rating system. I'll then go through how to get and interpret ratings for your stocks of interest and go through some of the most popular watch stocks and why they rank where they do. And lastly, I'll take questions. So thanks everyone for joining, and I hope you find the webinar informative. So I'm going to start by sharing my screen. I have a brief presentation that I will go through. About the quant rating model, at the most basic level, what our rating system does is it uses 5 independent, customized building blocks to score stocks on a scale from 1 to 5. Now, before I get into how our quant rating system works and how you can use it, let's talk a bit about what quantitative rating systems are and why they can be an important part of an investment philosophy. So quantitative models in general use data and historical relationships to evaluate stocks in a systematic fashion, unaffected by the emotions and bias that can impact decision makings in investing and trading. In addition, quantitative rating systems provide depth. That is, they can offer recommendations for any stock for which the underlying data is available. Our quantitative rating system uses a set of unique building blocks to provide a rating for each stock in the S&P 500. Some of the building blocks are based on traditional equity factors. We take those traditional factors and we make proprietary adjustments as part of our stock rating system. Other building blocks are custom to our model and are not part of any existing factor indices or ETFs. We also use a customized approach to normalize the 5 building blocks so that they can be properly combined to produce an overall stock rating. Now, the 5 building blocks are valuation, which measures how cheap a stock is compared to its fundamental value; quality, which considers operating strength of a company by looking for steady earnings and a strong balance sheet; momentum, which takes advantage of the continued outperformance of past winners; estimates, which consider how sell-side analysts' opinions about a company's future prospects are changing; and investment, which gauges how the company is spending the cash it generates and whether it spends that cash in the pursuit of growth. We evaluate each stock on each of these 5 customized building blocks. We then combine the individual building block scores to arrive at an overall score, and then use that score to recommend overweights and underweights within an index. Now, it's important to note with any stock rating system, the intended holding period. Our stock rating system was designed to use a 1-month holding period, but it has also shown outperformance over longer holding periods out to a year. Since the data underlying the rating system is only updated once a month, the rating system is not intended to be used for shorter time frames like days or weeks. So let's next go through the historical performance of the stock rating system. Let's start with the chart on the left side of this page. If each month we take the top rated basket of 100 stocks from the system, we hold those stocks for a month, and then we sum up the return, the orange line in this chart shows the cumulative performance we would have realized over time. For comparison, if you do a simple buy and hold strategy where you just hold the S&P 500, the performance of that buy and hold strategy is shown as the dotted black line here. Obviously, the performance is impressive, but to give a more granular look, let's move to the chart on the right, where we show the yearly performance of the stock rating system, which is shown as the orange bars, compared to the S&P 500, which is the blue bars. Note the consistency here. The system's basket of favored stocks has outperformed the index most years, and it's outperformed in both up years like 2013 and last year, and also in down years like 2008 and 2018. And obviously so far this year, it's been another down year for the market. But despite it being a down year for the market, the model has outperformed the market by over 3.5%. Now, turning to the next page, we break down the performance of the stock rating system by sector. In the case of a stock rating system like ours, that's designed to find outperformers across the market, you want to see consistent performance across all the sectors. And what this chart shows is the performance of the stock rating system's basket of top stocks compared to the return of their respective sectors. And that's shown as the blue bars. The orange bars show the relative performance of the bottom rated stocks in each sector. The bars represent relative performance. For example, the blue bar labeled energy right here at the left shows the performance of the rating system's top rated stocks selected from the energy sector and how those top rated stocks have performed compared to the entire energy sector over time. And from the chart, we see that in each sector, the rating system's list of top rated stocks has outperformed the overall sector. Likewise, the basket of bottom rated stocks, those are the orange bars, those have underperformed in nearly every sector. So while the stock rating system was designed to identify outperformers across all sectors, this result indicates that for someone who is focused on only one or two sectors, the stock rating system can still add value. So let's close this now, and let's go through how to get data out of the rating system and how to view individual stock ratings for individual stocks. So I'm going to start by going to the FS Insight webpage. This is the home page here. From there, you go to stock lists and you go to quant stock ratings, as I'm doing. You click on that and this page shows up. So you see the search bar pop up in the window. Here, you can enter a stock of interest to see our rating for that stock. So I'll start by entering Apple. Obviously, with the search function, you can enter the word Apple or you can enter the ticker symbol. Either one pops up. Now, I'll clarify, we only have ratings for the S&P 500 stocks right now. So if you pick a stock outside that index, the search function isn't going to return anything. But for now, we'll continue with this example of Apple. So I'll click search, and now the screen refreshes. And we have this additional little widget here where we have some information about Apple. Note the chart to the right here, the one labeled rating. Recall that we rank stocks into 5 buckets. The most positive bucket is to the right, that's this green label, and the most negative is to the left in red. In the case of Apple, it currently ranks in the 4th of 5 buckets. So if Apple is a stock you follow or a stock you're interested in, you can add it to your watch list by clicking this little watch button to the right. So after I do that, I get a little notification. My ticker has been added to my watch list, and I'm slowly building a watch list here. I have Apple. So I'm going to add a few more stocks to the watch list to go through some ratings and show you how the watch list works. So I'm going to add APA. I'm going to add SRE. And I'm going to add Disney. Okay, so note that my watch list has 4 different stocks on there now, obviously because I added those other 3. So if I go to if I go back to the home page, or I even leave the FS Insight website, and then I come back to stock ratings, these persist. So the stocks that I entered in my watch list are always going to appear at the top. The other thing about stocks on your watch list, because they persist here, they'll stay here. When the stock rating model updates, you will see updates for your watch list come through. And we update the quant ratings at the beginning of the month, usually toward the end of the first business day. So when we're done doing that, you will get the updated ratings for your stocks on your watch list. Now, with the 4 stocks listed here, it's important to note something. The model really focuses on the tails of the distribution, or stocks in the top and the bottom buckets. In this case, that would be APA, Sempra, and Disney. Apple, for example, is not in the tails. And the reason we focus on the tails is that's where we see the highest likelihood for outperformance and for underperformance. For those of you familiar with statistics, if you think of a bell curve that goes like this, for normally distributed data in the bell curve, most of the observations occur right in the middle. Right? But the rating system focuses on the observations in the tails, the outliers, because that's where we think we're going to find our highest likelihood outperformers and underperformers. So that's just a quick run through of how to use the watch list and the stock ratings. Now, one other thing you can do with the watch list is if I scroll down, I added the watch stocks, but also I can see stocks that other people are requesting. And that's kind of on the bottom of the page here. And I'm going to go through some of these most popular watch stocks right now to briefly go through why they rate where they do. So Google, for example, rates in the top, is in the top rated bucket. It's all the way to the right here. At a building block level, recall that we have 5 building blocks: valuation, quality, momentum, estimates, and investment. So Google rates highly on valuation, meaning it's relatively cheap in its sector; quality, which measures its ability to consistently generate profit and maintain a high margin; and momentum, which considers past short and medium-term price trends. The system also likes Lennar. You can see that right here. It also rates in the highest of the 5 groups. Lennar is in the top group on the value and investment building blocks and also rates strongly on momentum and estimates. So Apple is in the second highest group. At a building block score, it rates similarly to Alphabet, as both the quality and momentum scores are favorable. Where Apple ranks less favorably than Alphabet is on valuation. The lower valuation score for Apple knocks it out of the rating system's top group. Another stock that rates relatively highly is Cisco. It's also in the second highest group. So for Cisco, value and quality rate most favorably. And although its momentum score is poor, higher than average scores in estimates and investment more than make up for that poor score on momentum, which drives Cisco's rating higher. And lastly, I'll talk about a poorly rated stock. That would be Monster Beverage. That's down here. So Monster rates in the lowest of the 5 groups. It actually has a pretty strong momentum score, but on the other 4 building blocks, it rates poorly, either in the bottom group or in the next to the bottom group, which drives its rating down. So that's just a brief overview of some of the most rated stocks and why they rank where they do. And that really concludes my prepared remarks for today. So as we've shown, the stock rating system has generated consistent performance across time and across sectors. It can be used to identify likely outperformers or likely underperformers, either across the market or within sectors. And as I've shown, the system's currently up and running on our website, so you can use it to start analyzing stocks of interest. You can start adding to your watch list today. And let's start by answering some questions here. All right, so how often do the ratings change? So as I mentioned, the system updates once a month. That said, so you'll get updates on the ratings once a month at the beginning of the month. That said, it's not like every stock is going to change ratings every month. Like some stocks, like Google, for example, has been highly rated for over a year now. So it's not like stocks are going to go from the top bucket to the bottom bucket to the middle bucket. The model's not designed to do that. The model's designed to turn over at a much lower pace. So although the ratings will update once a month, you're not going to have the entire top bucket move out and the entire bottom bucket move in. So that I think that answers that question. Okay, so the next question: is the performance in the charts real time, or is some of it back-tested results? Okay, so that's a very good question. One thing I always like to say as part of my quant research is that no one will ever show you a bad backtest. So that's a really important question. In terms of answering that question for the model, so the backtested results are through the end of 2021. The model's been live through for this year. Now, that said, a lot of other quant models, there'll be things called meta parameters in the model. These are little knobs you can tweak in the model to make it look better. When I design models, I try to minimize that much. And in fact, the way this model is designed, there's really none of those meta parameters, none of those knobs and levers you can pull and tweak. It was designed very simply. So really, there's not much changing between the in-sample or the backtest result and the live result. And that's why the performance, I think, has been so consistent. So like I said, the model's been live since the beginning of 2022. Okay, so the next question. This is actually also a very, very important question. What if a granny shot is listed as an underperform? And this would go for any other stock list we have. This is actually a very, very important question. And I'll answer it this way. So the granny shots list is designed to find themes that we expect to outperform over a multi-year horizon. The model was not designed to find outperformance over that length of time, nor does it observe general themes. Like, themes are very powerful investment vehicles, especially if you have a multi-year horizon. The model, however, the way it was designed, it's not designed to really work over multi-year horizons. Also, it's just using data and quantitative inputs for stocks. It's not considering stocks on a thematic basis, whether they're positioned to take advantage of either secular changes or changes in demand or changes in technology. And that's exactly what the granny shots list is doing. So what I would say is that the two would be complementary. If you find a stock on the granny list and a stock that rates favorably, that would be a stock to look at. But they're really they were developed independently of one another, and they have different goals. So I would say if you find a stock on the granny list that's listed as an underperform, I would say over the multi-year horizon that the granny shots list was designed for, the stock is likely to outperform. Okay, so the next question I'll take is, do we benchmark against other quant rating performance, e.g. seeking alphas? That I haven't done because I don't have a way of outputting that data. If someone wanted to do that, I'm happy to, as I showed the historical performance, you can get the ratings. I'm happy to give you the performance. It's included as part of my monthly notes. You can benchmark against any quant rating system you want. I would just say that given the consistent outperformance of this quant rating system, especially it's only within the S&P 500. A lot of other quant rating systems will show extreme outperformance, but when you dig down, you find that, okay, they were long these very small stocks that happen to have 200, 300, 500% returns. This model isn't designed that way. This model is designed to stick with mid and large cap within the S&P 500. So that's how I would answer that question. Let's see some other question. Here's another question. So for what period of time are these ratings intended? So I briefly mentioned this during my remarks. The model rebalances monthly. It's shown outperformance. The top rated basket has shown outperformance for holding periods from a month out to a year. Anything shorter than that, it's not really designed to find outperformers over a shorter time span. But anything from a month to a year, stocks in the top rated basket should outperform the index. Let me look through. A lot of questions coming in. I'm sorry for the delay here. I'm just trying to catch up with them and find the best ones to answer. Okay, here's a good question. How do we know a stock has bottomed and is changing and is at a changing trend inflection point? So that's a good question. I would actually, so again, like I said, the model is not really designed to operate at timeframes shorter than a month. I think you can definitely use some of our other research products like Mark Newton's technical analysis. Brian Rauscher's earnings-based work would definitely help you find turning points. I think also, as far as the stock rating model goes, if a stock moves from the bottom bucket to the next to the bottom bucket, I wouldn't use that as necessarily a buy signal. I would want it to move. I think you would want it to move out of the underperform bucket all the way at least to the middle or the second from highest bucket before you consider it a safe investment. But in terms of finding those turning points, that's what I would suggest. Sorry. Okay, here's a good question. What is the rebalancing interval that yields the strongest performance among the ratings? Okay, so that's actually a good question, and unfortunately, it's not a simple, it's not a simple 1 month is the best. The problem when you're looking at different rebalance frequencies, one needs to consider the risk of the investment, right? So, whereas the you have to look at the risk-adjusted return when you're considering different investment horizons. Now, the risk-adjusted return is actually highest at the monthly rebalance frequency. The issue with that, though, is that you're subjecting yourself to more turnover. Obviously, like I said, the model was designed to have relatively little turnover, but there's still going to be some turnover, and there's going to be a lot more turnover if you're rebalancing at a monthly frequency as opposed to a yearly frequency. That said, if you're operating at a monthly frequency, you're using a lot more data points, and on average, the more ratings you have, the more likely you're going to find winners, and the more likely you are to outperform. So it's kind of it's a complicated, it's a somewhat simple question, but it's a relatively complicated answer because you have to consider transaction costs, you have to consider how often you want to rebalance your portfolio, and you have to consider, also your general holding period as well. So it's not a straightforward question to answer. I would just say it really depends on your investment horizon, but the model does outperform over 1 month out to 1 year horizons. Okay. Here's a question. Is there an alert when the evaluation of any stock has been changed? There's no alert specifically. It would just be if you have the stock on your watch list, you'll see the rating change, as I mentioned. And that kind of dovetails with another question. So right now, the way to get the data is through the website. There's really no other way to get the data out, unfortunately. But you can get data for your stocks of interest from the website. So that's how I would answer that. Okay. Another question. Have I built quant models previously in my career? Yes. What did I learn? Well, what I learned is that simple tends to be better. So when you're building quant models, there's two kind of modes of thinking. One is you can try to fit the data as closely as you can, and you run the risk of overfitting the model, which means that the model will perform well during your back testing and your in-sample period, but then when you run it live or at a sample, it'll underperform. The other side is to say, let's not fit the model so well, it won't perform as well historically, but then because the problem with financial data, it tends to change over time. And if you fit a model to a set of historical data, the relationships may change and the model may not work going forward. And for that reason, I learned you really want to err on the side of underfitting financial data. Overfitting with financial data can be a real problem. And the statistical techniques that I've learned over my career that try to help with that, to try to help to avoid overfitting. And if you're going to err on one side, it would be to err on the side of underfitting the data because it changes so much. The signal to noise ratio is so low in financial data. So that's what I would say I've learned. Okay, here's a question. Are weightings between factors static or dynamic? So right now, the weightings are just static. So that's why I also mentioned during my remarks that the model is pretty straightforward. Or I think I mentioned it during the Q&A that sometimes you have meta parameters or dials and knobs you can twist in a model. This model doesn't have that many of those because the weights are static. For that reason, to keep it simple. Again, that gets back to the overfitting and underfitting discussion. So, okay, here's a question. So if you don't have any particular stocks you watch, can you just list the top 10 stocks and comment on how to utilize the information, like in a portfolio? So the way I would look at it is one way to use the stock rating model is as a screening tool. So what you can do is if you take the S&P 500 as a whole, you take the top rated stocks that gives you down to 100 stocks. You can then fish from that advantage C to try to find ideas that you like. If you don't want to invest in 100 stocks, you can go 5 or 10 or do some more focused analysis on that smaller group of names as opposed to the full list of 500. So that would be a way I would use it if you don't have a particular stock of interest. The other way to use this, and I think this dovetails with another question down here. So another way to use the model would be if you're able to invest in a basket of 100 stocks, that would be the purest way to invest in the model. Of course, not many people can invest in a basket of 100 stocks. That's where ETFs and other products like that come in. But that would be kind of the purest way to track the performance. Okay. Now here's an unrelated question to the stock rating model. Are you planning on publishing your Reddit indicator? Ooh, just moved. Someone asked. Sorry. Are you planning on publishing your Reddit indicator more frequently? That's actually an interesting question. So right now, I think I've updated it twice. It's definitely something I can update more often. That's something we're considering. So we're definitely considering it, and I appreciate the feedback. And if there's interest, we'll definitely get that going. And for those of you who don't know, originally in April and then in August, I published a note about using Reddit and using comments about the general market from Reddit to gauge sentiment of Reddit users toward the market, and it actually works as a pretty good contra indicator. So when Reddit-based sentiment on the market is negative, the market tends to rally in the short term. We're talking 5 days, a week after the observation, and vice versa. When sentiment's very positive, the market tends to sell off. So that answers that question. I don't want to get into too much detail about the Reddit indicator on this webinar, though. All right, here's another question. Can we filter the outperform rated stocks? So we don't have that functionality right now. Again, what you could do is if you had a large list of watch stocks, you could see how the ratings come in and see how the outperform, how the data comes in for the outperformers versus the underperformers. But that's something we can look at. We can look at implementing. It's not solely up to me. There would be other people that have to get involved with that. I don't want to get into the details. So that's something we can look at. And we would have to get back to you on that. So let's see. Oh, here's a good question. Does the model perform better in pair trading, e.g. outperform versus underperform in the same sector? Okay, so the answer to this question is yes, it does perform better, outperform versus underperform. The performance I quote is simply just the long-only strategy of holding the top-rated stocks, the outperform rated stocks. The reason I do that is because shorting stocks is generally difficult. It's not everybody has access to do it. There's funding costs involved. There's liquidity sometimes involved. So that's why I show the long-only performance. But on a theoretical basis, I do have the performance historically outperforms versus the underperforms long, short, and that actually does outperform the long-only. So that's a good question. Okay, so here's a question. So looking to better understand how the building blocks drive the rating. For example, Ford is currently listed as a high outperform. How will this week's financial guidance from Ford drive the rating? So, okay, that's a good question. So each of the so there's 5 ratings, like I said. So the valuation, which is the first factor, will look at common ratios like price to forward earnings, free cash flow, things like that. So as a company reports its financial statements, we'll get the update. We'll report it once a month, and that'll flow into that factor. Other factors like quality looks at the strength of the balance sheet. That's also updated. Momentum looks at the price trends for Ford. So if Ford sells off, that'll be, or if Ford continues to sell off, that'll be a negative for the momentum factor. The other 2 factors, the estimates factor, will look how analysts have changed on their. So the estimates factor is actually forward-looking. So it won't look at how this quarter changed. It'll look at how the subsequent quarters changed versus now. So if analysts have lowered their expectations for Ford in the future, that would be a negative for Ford. And then lastly, the investment factor will look at whether they're using their shares to buy their money to buy back shares or engage in research spending, things like that. So that's how the data will flow in when you have an update like that. And as I said, the model updates once a month. So depending on how the data comes in, the individual building blocks will go up or down. Obviously, it's impossible to predict for how that will happen, but at the end of the month, we'll see what happens with Ford. So let's see. I assume the algorithm is based on fundamental analysis, no technical analysis involved. Um, well, so there's no technical analysis in the purest sense of the term, although one could argue that momentum and its derivatives are technically derived because they're based on past price. So that would have a technical component. So yeah, so that would answer that question. Okay, here's another question. How do you handle times when a sector has no strong outperform or strong underperform rated stocks? Okay, so this is an actually interesting question. That will rarely happen because the model is designed to find outperformers and underperformers within sectors. Occasionally, it will happen with a small sector, like real estate. Occasionally, there'll be no stocks in either category. I think sometimes materials, but the quote unquote larger sectors like your energy, technology, healthcare, larger sector, discretionary, larger sectors like that will always have at least a few stocks on either side. So, all right. So let's see. Here's another question. The results you show comparing to S&P 500 is very impressive. My question, can you please explain more about the strategy? Sure. So again, all that chart is showing the performance of the model versus the S&P 500. Each month, it's taking the list of 100 top-rated stocks, holding them for a month, and then rebalancing the next month. And it's just doing that through the whole history. So each month, it looks at the basket of top-rated, the basket of 100 top-rated stocks, and it's holding those for a month and just rebalancing and continuing forward. So that's all the strategy is. It's purely mechanical, takes the results from the model, forms a basket, and just trades it through history. So, okay, let's see. I think that mostly does it here. Yeah, I think that mostly answers all the questions we have. Yeah, so again, I want to thank everybody for for tuning in, and I hope you found the webinar helpful and useful, and feel free to go on the website, add stocks to the watch list, look at the data for the model, send us feedback. We'd love to hear from you. And yeah, again, thank you.